All right, hello to the next lesson here. I know you're looking at a blank screen for the moment, but that's because I'm having some difficulties with this whiteboard that I'm working with here. So because of that, I had to clear my cache or something, whatever the hell it was. So on with this. Anyways, all right, so the example we're going to focus on is October 31st, 2019. Jason Corp receives a bank statement from 13th National Bank reporting its cash balance as $150,135. Right, so again, that's what they received from the bank. Bank says, we see $150,135. They looked at their ledger balance, and the ledger balance stands at $147,895. So there's the two numbers you're going to have to reconcile between. In other words, somewhere between those two numbers is the correct cash balance. Now, using the bank statement as your source document, you'll gather some information from that, and this is what they found out in the initial run-through, as you'll see in a moment what I mean by that. So first, they found a deposit made on the last day of the month, very common. So $5,860 does not appear in the bank statement. So again, in the brackets at the end, I tell you how does it fit into the formulas that we looked at. In this case, it's a deposit in transit, and then the notation you're looking at here is what's the adjustment you're going to do. You're going to add that to the bank balance. All right, number two is you had three checks, 841, 43, and 49, totaling $8,250. Do not appear in the bank statement. Now, these, of course, are examples of outstanding checks, and they should all be subtracted from the bank balance. Once again, to recap, you added the deposit because that was an amount, or you've already added to your company balance. Bank hasn't received it yet. You subtract the checks because you've already subtracted them from your cash balance, but the bank has not. Now, what's the rule with outstanding checks? They remain outstanding until they clear. So until they clear the account, meaning in this case the bank account, or they go stale. Stale means they're no longer negotiable, meaning you can no longer cash that check. Now, what's the rule with dealing with a stale check? The general rule is this. If it's a small sum of money, like we're talking $5, $10, like a rebate check of some type, you would reverse the original entry, put the cash back in your account, and then don't do anything else, because it's, again, materiality dictates. It's immaterial, nobody cares. If it's a material amount of money, like let's say $300, $400, you assume somebody wanted that, but somehow it slipped through the cracks, so you reverse the original transaction, whatever that means. Like, for example, if you were paying on an account payable, the original transaction would have been, you debited AP, credited cash. So now you would just do what? You would reverse it by putting the cash back in there, and then to debit that and then credit back the AP, and then you reissue a new check and then do the original transaction now, but again with the fresh check. So debit, accounts payable, credit, cash, and then send it out. So when you're in reality, when you're doing a bank reconciliation, guess what you have to do? You have to actually, step one is really, I don't include it here, but you have to go back and look at the previous bank reconciliation for any outstanding checks from the previous one. Because why? Because if they're still outstanding in the next period, meaning you look at those checks that were outstanding in, let's say in this case, in the month of September, and if they still haven't cleared the bank balance, they would still be continued to be outstanding checks on this reconciliation. Again, until they clear or they go stale. And again, how long that takes depends on the bank balance. So look at your agreement. I think 120 days is pretty standard now, but some, like government checks, can be a year before they go stale. Right, number three, the bank issued a credit memo regarding a note collected. In other words, this was a service provided by the bank. You took like a note that somebody owed you, a note receivable, and you gave it to the bank, and you told the person that issued the note to you, the maker, you said, don't pay me, pay the bank. So the bank's holding it, and then they came in and they paid the full amount here. In this case, it was the face amount of $10,000 plus $500 of interest, so the total amount collected is $10,500. Again, notation for this should be, this is an amount that your company didn't know about, so add that to the ledger balance, plus the ledger. Number four, the bank issued a debit memo for $25 regarding service charges for the month. In this case, the notation should be subtraction from the ledger balance. Again, you didn't know about it, but the bank did. They're informing you. And then number five is one of my favorites to talk about in this section of the handout. A bank issued a debit memo for $1,535 regarding a $1,500 NSF check from Heat Company, and you got charged $35 for depositing that check. And same impact as number four will be subtraction from the ledger. So first of all, what does NSF mean, or NSF check? Means non-sufficient funds. Means when you put that check in, it went into the system, and then they tried to draw it upon the account, in this case, He Company's account. When it reached there was not sufficient funds or overdraft protection to cover that check. Like whatever the overdraft protection wasn't sufficient, so what do? They kick it back to your bank, the bank that you deposit it with, and then so you basically get back the check as being rejected. That's all NSF check means in this case. Question I usually ask when we have an actual live, I started to say live studio audience, whatever, actual classroom setting, is like, where does that $35 come from? Like, where did that number come from? Is it some federal mandate or whatever? And the answer to that in quick is no. Banks just make it up. They make up a number and decide how much to charge you if you shouldn't perhaps have a check that is non-negotiable, like this one becomes NSF. It was one of those things that they fought hard for back in 2008 into 2009. We had the meltdown in 2008, and then in 2009, when they were putting together a regulatory bill, this is one of the things they tried to regulate, to say put an upper limit on it. They wouldn't have it, and you couldn't get it through Congress. There was no way. Too much leverage there. Why? Because they make too much money on it. That's the bottom line there. Ask people who work in banks. If you happen to work in a bank, you'll probably go, yes, they make a lot of money on that. So that's why they wanted that amount to be up to them. And remember, that amount gets charged to you, and they also charge the person who gave the bounced check, the NSF check. So there's money made on both ends on that. All right, now we're going to go to the next one here. And we're going to look at the actual bank reconciliation itself. All right, now you'll notice, of course, kind of giving away the plot in this case. Yes, we start with, again, this is our initial pass at the bank reconciliation. That's what we're going to focus on right now, meaning the one where there was something wrong. So initial run through, this is what you did. So you took this unadjusted balance for the bank, which is 150,135. Just recap that right there, 150,135, as you can see. So we're going to take that number, and again, I said outstanding deposits, same thing as deposits in transit, whatever. So we're going to add back that 5860, and we're going to subtract all the outstanding checks, and then our preliminary number we get here is we get 147,745. Now we take the unadjusted balance per the ledger. Again, that was 147,895. Remember, we're going to add the credit memo for 10.5. We're going to subtract the NSF check and the service charges. That leaves us with this number here. So we get 156,835. So we look at the discrepancy between the two numbers, and we get 90,000. Obviously, it's 9,090. It's just been a long everything. You know that. Anyways, what are we going to do with that? Like, do we say, hey, that's fine, we don't need to look into that? Well, you'd probably say, well, the magnitude of this account, you'd agree, is somewhere in the $150,000 range. So you go, yeah, we probably want to look for that number. Now, again, you'll notice the concept of materiality is going to change a little bit when we talk about cash. So, like, let's say if I throw at you this idea, let's say we have a $10 million or $100 million balance, and we were off by this much. Would we still look for it? Well, if you look at $9,090 in terms of 10 million or 100 million, it's not that much. But yes, we'd absolutely look for it, because somebody could be stealing from you. So the next step may not be $9,090, it might be $90,000, as I started to say accidentally, and $90 or $9 million or whatever. They might just empty it out. So you want to look into that and find out what has happened. Like, what has caused this error? Is this just, whoops, we just made a mistake, or is this in fact something significant that needs to be looked into because somebody has found a way around your internal controls? So that's why you would even look into something as small as, let's say, $500, because I'm going to attempt to draw over here on the whiteboard, because this is the path. And let's say I got to give you a couple of things. So down here you have time, which I will try to draw with the mouse. So far it's Tim. No, put an E on the end, and now it's time there. Sorry, Tim. And then we got money over here. This is what, when somebody is stealing from a company, what it looks like. It starts like this, and then at the end, and it goes up like that. Now this spike that you see here is indicative of usually one of two things. Either number one, they just get greedy, or they think they're about to get caught and they get greedy because of that. They say, to hell with it, and I'm just going to throw caution to the wind, and we're going to steal a lot. That pattern is usually airtight, happens all the time. That's what you'll observe. So because of that, that's why you look at small discrepancies, seemingly insignificant, like $500 out of 10 million, whatever. Could be big though. So you're going to look into that, and because why? It might be just somebody doing a test. Like you're up by $415.86 because why? Somebody's stealing that money because they found a hole in your internal control system. So maybe the next discrepancy is, a little bit higher, but not significantly. And then eventually, if this goes on long enough, then the big score is then it's off by $175,000 because they just decided I'm just going to go for this. All right, now what if you're off by, like, let's say 50 or fewer dollars? In that case, I say you plug to the bank balance, and that's all you need to do there. And this, of course, is all following cost-benefit dictates. In other words, we look at $50. Someone has to steal $50 from us, repeatedly. It doesn't add up to that much money over a course of a year. It's $600. And again, stealing $600 over the course of a year at the risk of being thrown in jail is probably a bad risk-reward when you're looking at it. All right, so we're going to have to do some error detection here because we are off. Now, the first thing we'll do with error detection is we'll start with comparing deposit tickets. Oops, I got to freeze that sucker. It's going to float all over the place. Deposit tickets to the ledger and bank statement book. And this usually takes about 2 seconds, by the way. It's very, very fast. They just say, oh, deposits usually, it's a few documents to worry about. They usually match up. Again, unless somebody's stealing from you, they should match up. Again, withstanding theft. And now comparing cancel checks, that's your big problem. There's still a lot of paper out there. And back in my day, I didn't do this, but somebody I worked next to had to do the bank rec, and I remember him being brought boxes and boxes and boxes of canceled checks. And if this initial bank rec didn't work out, as it usually didn't, then he would have to go through all those checks and play. Basically, the game was which one of these things doesn't match, right? So that's the game you have to play. So the first thing to keep in mind is the canceled check is reality. That's what it was drawn for. That's exactly how much it should be subtracted from your account, how much in your books, and that's how much the bank should have subtracted. So you compare it. Okay, the check is for $5,000. We took $5,000 out of our account. The bank took $5,000. Then you just go to the next one because everything checks down. There's no mistakes. So in this example, there was 2 errant checks. So it was 833 and 840. Now with 833, we compared the canceled check to the ledger balance, and you'll notice they both equal. But over here, the bank said it was $540, not $450, because what the bank did is something called a transposition. So they transposed the 4 and the 5, and that's how they got that error. So the rule that I want you to abide here is not understand what the error itself is. So when you look at this column here, it says error. This is how to get rid of the error, how to correct the error. So you're going to take the errant amount minus the canceled check, that's reality, and that will equal how to get rid of it. In other words, add $90 back where? Who made the mistake? The bank made the mistake. So add $90 to the bank balance, and that will take care of that error. So if you go back here, and now we're in the corrected column, that's what I did here. Added $90 to the bank balance, and now we get $147,835 as the correct balance there once they corrected that. Now this is, in reality, an unlikely error that a bank will make. Most likely error a bank will make is they'll take money out of your account that it shouldn't have been subtracted. It's like, let's say they're off by 1 number, and usually that's why we use check numbers, pre-numbered documents, as a way of understanding, hey, did they give us a wrong amount or not here? Or excuse me, they take it out of the wrong account or not here. So in this case, again, just a theoretical error I'm giving you here. And the type I was describing, how would you tackle that? You just tell the bank, oh, I'm sorry, this check you subtracted from my account, it's not my account, it's account number so-and-so. Just add the money back to mine and take it out of theirs. And that's all you have to. That's happened to me before. So it's not common, but it's not completely uncommon. You may encounter it in your own life. All right, so that was our first error. Second error was check 840. In this case, the canceled check said $10,000. The bank agreed, so they were both copacetic, but our ledger balance was only 1,000 because why? Because our AP clerk slid the decimal point to the left, understating the amount by 9,000. So again, the errant 1,000 minus 10,000 equals, again, so what do we have to do here? We have to subtract $9,000 from who? That would be our ledger, because we made the mistake. The company made the mistake. So the adjustment here to the reconciliation, you'll observe, is right there in the corrected column. Subtract $9,000, and you'll get the same balance for $147,835. And so we get a yes, they both equal, and then bank reconciliation is completed. Now with that done, the next step is to make that bank reconciliation basically live. In other words, whatever you did here, let me clean this up a tad just because it gets a little bit busy here. Whatever you did here will take care of itself. You know, the deposit will eventually reach. You call the bank, hey, add 90 to our account, you transpose the number, done. These checks will eventually clear. But what you did here has to actually be booked. Right? In other words, to bring you to this corrected balance, you're going to have to book all those amounts. So that's why this part of the bank rec is a source document for journal entries. And with that, we will stop and pick up the journal entries on the next installment.